You were about to hear an absolutely extraordinary interview with legendary Felix Zulauf. But first, this segment is sponsored by Keegan Resources, which has an incredible institutional shareholder base, which includes BlackRock, JP Morgan, VanEck, Broad Asset Management, and others. The company is one of the premier up-and-coming mining companies in the world and is now involved in a friendly merger with PMI Gold, which will create a gold powerhouse with the combined companies having total resources of nearly a staggering 10 million ounces of gold. The company is fully funded with $340 million in cash and has no debt, and the combined companies will be producing a robust 200,000 ounces of gold next year and are looking to add another 150 to 200,000 ounces over the next few years. Keegan Resources, symbol KGN in Canada and in the U.S. This is King World News. I'm Eric King, and you're about to hear from Felix Zulauf. Remember to go to our homepage, kingworldnews.com, where we will have a special release on Sunday with Egon von Greyerz out of Switzerland, and where we've already had John Hathaway, Gerald Celente, and Eric Sprott. But without any further delay, here is Felix Zulauf. Joining us now is world-renowned money manager Felix Zulauf, who has been a Barron's Roundtable panelist for over 20 years. Felix, I wanted to start off right away talking about the money printing with you because there's oceans of paper money out there looking for a home. We have stocks looking to break out to new highs. Where are we right now as you see it?
Well, you are quite right. There has been a lot of money printed by the central banks, and I'm counting 38 countries around the world that are pursuing zero interest rate policies or negative real rate policies. And you can go back in history as far as you can. You won't find anything like this. So this is history, money printing history at its best, so to speak. They have printed over $10 trillion of new money in different currencies, and they have used that to buy bonds. That tells you how distorted the bond market is today, because without those huge amounts of money printed and invested in the fixed income arena by the central banks, you can imagine that interest rates would be quite a bit higher, and there are other markets that are being priced off those manipulated interest rates would be. So I think the world economy is still in difficulties. We see that some leading indicators, etc., are ticking up a little bit, and the world is getting very optimistic that we have passed the crisis, we have solved the problem, the world economy is healing, etc., and sentiment is very optimistic. Actually, it is as optimistic in the stock market as it was in 2007. I think we have entered a very dangerous territory. I think that the world economy will not deliver what people expect. You just saw this morning the numbers coming out about the Eurozone GDP in the fourth quarter. It was quite a bit weaker than expected, still in the negative territory, of course. And while general consensus is expecting maybe a mild recession of 0.5% or so this year, I think we will probably see minus 2% in Eurozone GDP for this year. So we are not out of the woods yet, and the market is very euphoric. And that creates a very dangerous combination, because the markets are expecting something the real world will not be able to deliver. And therefore, I think it's very, very dangerous. So I think we are building a top in global equity markets. The whole run of the 2009 low is in the late stages and building a top. The last cycle lasted about 4.5 years, from the 2002-2003 lows to the 2007 highs. The cycle before that lasted 5 years, from early 95 to 2000. This current cycle is now 4 years old, so we are on borrowed time. We are in the later stages. We do not know how this top will unfold. It could be that we have a correction very soon, and then another run to the higher highs. Even some indices around the world making new historic highs. Marginally, I cannot exclude that. But the second run, if that happens to be the case, the second run would not be confirmed by internal technicals. What do I mean by that? I mean that the number of stocks making new highs is declining. We see that already. That the number of markets around the world that trade above the 200 moving averages is declining and not confirming the current world indices going to higher highs. The number of markets with rising 200-day moving averages should not confirm. Right now, that one has confirmed. So it's not that the market is going to break down badly from here next day, but it's a top-building process that we are in. If the markets do not correct, as I expect, sometimes in spring, and then have another run-up, if the markets would continue to go up and not being confirmed by internal technicals, then it gets very, very dangerous. Then we would resemble much more a market situation that has some similarity to 1987. I'm not forecasting a 1987 crash, but I'm just saying we are in dangerous territory, and people should be aware of that and take precautionary steps.
Felix, I'm going to ask you a question that I asked Art Cash, and very recently there was the call last week to print $30 trillion, and at the beginning of 2011 there was a tremendous amount of publicity surrounding the call for $100 trillion to be printed. When you look at this, is it being implemented in stages, and those kind of numbers being thrown around are sort of shocking?
Well, they are. They are shocking. You know, I can tell you an experience by myself. In my home country, Switzerland, the Swiss National Bank has bought equities for 50 billion Swiss francs. And I, as a citizen, I have to first earn my money, pay taxes, pay for the cost of living, and what remains is the savings. And out of those savings, I can invest in some stocks. These guys just print money. That's unfair. That's cheating and betraying the citizens of their own country, and that's going on around the world. Most other central banks have not invested in equities, but they have invested in fixed income. They are financing countries and governments like those in Europe that do not do their homework and have therefore distorted interest rates on the low side that prevents them from doing their homework and improve the household budget and things like that. And the same in the U.S. These are manipulations like we have never seen it. And, of course, the printing of money comes in waves. Right now we have the new wave coming out of Japan because the Japanese now think they can fix their situation by printing money. That will work for a while, but it won't fix the problem in a sustainable way. That's impossible. And after the Japanese, I'm sure the Europeans eventually have to join in, because how can European economies, particularly the debtor countries, compete with the euro trading at current levels against the Japanese yen or against the US dollar? That's impossible. So there is a competitive race in the currency markets. Of course, central bankers say this is not competitive devaluation. We just pursue our own domestic policy, and the end result is that a currency goes up or down or whatever. But this is a very dangerous thing. You have to understand it's like the pie as the world economy, as I see it, is not growing enough, and therefore we have all sorts of systemic problems, and everybody tries to increase his share of the pie by devaluing its own currency and making that share a little bit bigger. This eventually will not solve the problem, but it will lead to angriness and conflicts among nations. It's a very, very dangerous game that is going on.
Felix, you're saying that this is a very, very dangerous game here. Can you expand on that just a little bit more?
Well, obviously, let's say the Japanese are successful and they reduce the value of the yen to, let's say, 120 or 130 to the US dollar over time. And let's say all the other currencies would stay where they are right now. Obviously, it is very clear that those competing with Japanese products in the world markets, like the German car manufacturers, or particularly the Korean car manufacturers, or U.S. machinery companies, or whoever, they obviously suffer a competitive disadvantage because they cannot cope in price. And therefore, they have to reduce their prices, or their central banks then have to manipulate their currencies lower, which creates a problem for the other guy. So it's begging the neighbor policies that we are seeing, and it comes out of the situation that we don't have enough growth, economic growth.
In those kinds of situations where you get friction between the countries, the Japanese might complain that over time the Korean currency has lost 60% of value versus the yen.
Well, the Korean currency actually has only devalued against the yen because the yen has been rising. But the Koreans have had a very steady and stable currency against the U.S. dollar and against most other currencies. The Japanese yen was an outlier because of the deflation they are having and the policies pursued. The yen strengthened, and it was a systemic current account surplus nation. That is now coming to an end. We have a serious deterioration in the external accounts of Japan, and that's the real reason that the Japanese are doing it. The Japanese are not able to finance from domestic savings their current and future deficits internally anymore, the budget deficits. You know, in the past, they had built assets outside of Japan, and they have withdrawn those assets over time. And that means that they could finance for a very long time a deficit policy for many, many years. And now this is coming to an end. And therefore, the central bank has to finance it. We have the trade account in deficit. We have the current account is now deteriorating sharply and approaching a deficit level. This is new news. So we have a sharp deterioration of the balance of payment of Japan, and the Japanese are now going to pursue a policy of weakening the yen, and they are printing money to finance the domestic deficit, which is on the order of 10% or so. And you know how the indebtedness of Japan is. It's about 230% of GDP, or along those lines. And if Japanese interest rates that are below 1% for 10-year money, if those would double, all of a sudden they had to pay 50% of their tax revenues just as interest payments. Things like that. It's a very desperate situation and very, very dangerous because desperate people, desperate nations become very, very aggressive.
Felix, you bring up the Japanese there. Obviously, they're a new entrant into the gold market, and it seems that despite the fact that mainstream media across the world is sort of trumpeting the end of the gold bull market, it seems to be holding on quite nicely above $1,600. Let's talk gold. Where are we there?
Well, in 2011, we had sort of a buying climax when gold moved very quickly from $1,500 to $1,900. And that marked sort of an end of one stage. And I said around those times that we will go through a lengthy correction and congestion period, which we have done. It's now quite some time. And we went from high optimism in the gold market to very low optimism or even pessimism. Actually, the sentiment numbers you see in the gold market today are about as depressed as they were when gold declined in 2008 from over $1,000 to below $700. So corrections are here to improve the technical situation of a market. And you go from high optimism to deep pessimism. And that's what has happened in the gold market. The fundamentals, as I just described a while ago, are here. We have negative real interest rates in a high number of countries and currencies. That means that they constantly debase paper currencies, which is bullish for the gold price expressed in those currencies. Therefore, the fundamentals remain fully intact for gold because paper currencies continue to be debased. What has lacked was the improved technical situation of the gold market. And I think we are in the later stages of this cyclical correction. Probably this will end sometimes within the next 2 months or so, and then we will rally again and go to new highs. The first step will be important to break 1,700 on the dollar price of gold. Now, you have to also look at the gold price in other currencies. And obviously, the biggest run it has had was in Japanese yen. When a country pursues aggressive devaluation of its currency, the price expressed in that currency of gold goes up dramatically. And so the Japanese citizens that are holding their savings in yen, obviously they won't buy any JGBs, government bonds anymore. They will probably buy some stocks, which will come, in my view, and they will buy gold to protect them, to protect their savings. We have had some negative developments recently in Asia. India has increased the import tax for gold and things like that, that is dampening temporarily the demand for gold. And India has done it because of the bad external account situation India is having and things like that. So temporarily, those factors dampen the demand for gold, like in India, but then there are others, like Japan, that comes around the corner and where demand will go up. Moreover, there is a new buyer around the block, and that are central banks. Over the last few years, you saw steady buying by central banks, whereas in the 10 years before, you saw steady selling by central banks in an aggregate sense. And think about all the surplus countries in terms of current accounts. Where do they put their surpluses? In what currency should they store their surpluses? Should they do it in the dollar, where they are printing 85 billion new dollars every month without any work behind it? Should they put it into the euro, which is a misconstructed monetary union? Should they put it into pound sterling, where they are printing money even more than in the U.S. on a relative basis? Should they put it into the yen, where the central bank is going on a major money printing exercise? I mean, eventually, these guys, like the Middle Eastern guys, like the Asian surplus nations, like Russia, etc., they buy more gold because they say, in the long run, I'm better off with gold than the currencies that we have been buying in the previous time. So I'm quite constructive on gold.
Felix, we've discussed the end game previously, and we talked about the money printing earlier, the 30 trillion, the 100 trillion, the numbers that are being thrown around. You talk about gold being strong, being late in the cycle here in terms of this correction and ready to advance once again to much higher levels. But where do you see gold headed ultimately in terms of the money printing that we're going to see, that we have yet to see?
I really don't know. It will depend whether the world will solve its problems in a conventional way or not. It's very difficult to imagine that the world is able to solve its problems in a conventional way. More likely, we will see currency reforms and things like that, and government controls, more government controls on capital flows and things like that as things get out of control over time. So I cannot really tell you, but I think investors should take it step by step. And the fundamentals for gold are quite bullish. The technicals have improved quite a bit. And I think as soon as we break 1,700, that is a good signal for the next upcycle within the secular bull market that is ongoing. And I would expect this year to see new historic highs in the price of gold. And then we take it from there. You know, the important thing is that every investor should have part of his savings invested in gold.
We've always said that historically. You should have a portion of your assets in gold, Felix. But when you talk about this type of money printing, which the world has never seen in such a global, coordinated manner, how much money do you need to have in gold in order to not see the value of your savings destroyed?
Well, it's a little bit of personal taste. You know, it's not the same for everybody. I have always said I would put about a quarter of my savings